Financial Accounting, Chapter 7, Internal Control and Cash, Part 2 of 2. Part 1 of Chapter 7, we discussed at length and in depth the process of the internal controls set up within a company to ensure there is no corporate malfeasance, to ensure the financial statements are recorded properly and in accordance with GAAP, and to ensure that there is no embezzlement. Of course, if you take an auditing class, you will understand the fraud triangle and how there's motive, intent, rationalization, opportunity. We will talk about greed. We talk about a lot of interesting subjects related to fraud. But what we're going to talk about in part 2 of 2 in this chapter is some of the controls that we can set up over cash to ensure that cash, which is very liquid and very easy to hide, to ensure that our cash is properly accounted for. Cash includes not just dollar bills, it's coins, currency, checks, money order, and it is the most likely to be stolen, and cash has to be controlled from the time it's received to the time that it's deposited in a bank. Cash registers provide a really strong control, and that separation of duties that we've talked about several times helps. So if the customer comes in and provides cash, that cash is recorded and the receipt goes to the accounting department. There's a journal entry that is recorded, and then the physical cash itself, it goes to the cashier's department, and that cash deposit that goes to the bank is a safeguard that we have after it gets, of course, out of the cashier's vault. But then the bank will send a bank statement and a deposit ticket to the accounting department, who double checks with the individuals within the cashier's department to ensure that the two match. Now, we talked about one of the problems that you can have with internal controls, and that is collusion. So if you've got the accounting department and the cashier's department in collusion working together, then you can't really rely on your controls, and so that's something that has to be carefully monitored. And again, it's that professional skepticism that occurs in accounting, because we as accountants are in charge of such a large part of the company's operations. If there's fraud going on within a company, then regardless of how successful that. One thing regarding the cash register is that the cash register, and I've got an old school picture down here, this old cash register, of course they look differently now, this old cash register helps protect cash because there's a sales ticket. Oh boy, here's the old picture right here of the sales area, and that cash is recorded in tape, electronically recorded in the accounting records in the general ledger as a debit to cash and a credit to sales. But what if at the end of the day, when the cash drawer is removed, they find that there is an error? That's when we talk about the over and short account. So in this example, if the sales recorded on the cash receipts are actually $35,690, and then the cash that's counted is $35,668, there's $22 short, and it's just one of those things. It's like an expense. If it happens frequently, an investigation should occur, but often you're going to find small errors like this from day to day. In accounting, we refer to something as the level of materiality. $22 in the scheme of $35,690 is not a material amount. But as I said, we would continue to monitor it. And I'm guessing most students have had an opportunity or have had a situation, where they've either received too much or too little change when they paid for something with cash. EFTs, electronic funds transfers, are also ways for sales. So those of you that do those of you that do purchases on eBay or Amazon are probably using PayPal or a credit card. I always suggest PayPal because I think it's got a stronger layer of security than your credit card. Companies that use EFTs have an enhanced internal control because there's no cash exchanging hands, there's no checks exchanging hands. In fact, I don't even know if a customer using eBay or Amazon could actually write a check to make a purchase. You can use a debit card, but not write a check. So electronic funds transfers are very, very important. Walmart won't do anything unless they do it electronically. That's one of their largest internal controls. Voucher systems are set up to show proof of authority to pay cash or issue an electronic funds transfer. So payment vouchers, sales vouchers, there's a lot of vouchers out there to make sure that we have a proper procedure and what we call an audit trail. And this is the trail of paperwork. Of course, it's now electronic paperwork, you might say, that follows a transaction. Bank statements. This, as I've indicated here, is frequently online by individuals. But for a business, for a company, they often will receive a hard copy of a bank statement and do something called a bank reconciliation. So here's an example of a bank statement with ending balance, a beginning balance, and deposits and withdrawals, and here's their new balance for this company. And it shows the checks and other debits over here and the deposits here. Notice down here there's codes. Look at those in a minute in a separate slide. This is a quick example of a real bank account from Wells Fargo, where something you're probably familiar with looking at, I hope. Here's one from a purchase at Rite Aid, a purchase at a Shell service station. Here's an e-deposit that was made in Mount Pleasant. Then you can come over here and you can see some online transfers. I've done some whiteout to get rid of personal information, but wanted to show you what one might look like. And yes, this comes from one of my 3 children. Just a transaction history from last year for some of the transactions that occur. What I want you to see is date. Notice there's no checks written. These are all EFTs. These are deposits in a long list. These are withdrawals. And this is a running balance, just like a ledger that goes all the way down through, so you can see what your balance is after each day. Now, a bank statement maintains a record of all of these checks, and it's typically mailed monthly, or it's done online. And the bank statement shows, as we saw in the others, a beginning balance, additions, deductions, and the ending balance. So let me pause and remind you of something or clarify something. The first example that I showed from the textbook showed an actual bank statement. The second example I showed was just a listing of the different transactions that occurred within an online bank account. So let's look at company and bank perspective. And I've already had a couple of you email me, and students always ask this question. I don't understand how the bank debit and credit is backwards. So let's look at it this way. Let's say that you own a landscaping company. This is your landscaping company. The asset is increased by a debit and decreased by a credit. It is an asset. It is an economic resource for you as the owner of a company. From the bank's perspective, the money you put in is a liability. Stop and let that process. The money a customer puts in a bank is a liability, and the increases in that liability are credits. So when you ever hear you get credit for something, or they gave you a credit to your bank account, that is an increase, and that's things like deposits or loans that you received. So increases in a liability are done by a credit. Now, whenever you see a debit in your bank account, that means that there is a decrease in the bank's liability, and that's for things like checks or electronic funds transfers. So that's why a debit card is taking money out of your bank account, because it is a debit on the bank's accounting records. Because on the bank's accounting records, your money is a liability. I would love for anyone who listens to this slide to shoot me an email. I'll give you a couple of points extra credit on a quiz at boltc@citadel.edu to let me know if that makes sense to you or not, because it's a tricky one. But this should be a light bulb moment for you. Okay, here are some acronyms for some of the types of challenges that can be found on a bank statement. Errors happen all the time, whether it's a business that incorrectly records a check or deposit, or sometimes the bank will make an error. I've seen that in my career. NSF is non-sufficient funds. Sometimes a customer will give a business a check and the check bounces. And there are service charges and miscellaneous items. Now you're going to see this. This is a new concept for just about every student in a business program. Collection of a notes receivable on behalf of the company. Sometimes the bank actually takes a direct deposit from a customer and puts it into the company's account. And that's where you're going to see collection of a note. So let's look at this bank statement and let's look at what are the challenges that we're going to face. We have a company called Power Networkings. And this is their bank statement. And their bank statement shows that they have $3,359.78. This comes from the official bank statement from the company's bank. But their records, now if you're taking notes, this is a note. Their records is the balance per their checkbook. If they actually had a checkbook, it's what your checkbook would show. It's the balance that's shown in their T account or their general ledger account that records all of the transactions. And it has the deposits and checks, and frequently the two of these things are going to be off. Bank reconciliations account for the difference between the accounting records of the company and the accounting records that are received from the bank itself. And it's the balance in the cash account. So the company probably doesn't have the service charges recorded because they don't see those until the end of the month. The company doesn't possibly know the NSF checks or some of the interest income or the miscellaneous debits and credits. In fact, until you open up your online bank account, you probably don't know how much interest you've earned for an accounting period. Now, the bank doesn't have record of outstanding checks. So let's stop and think about this. If you own a lawn care company and you've written a check and the person you wrote that check to hasn't cashed it yet, it's not on the company's bank statement yet. So the bank doesn't have it yet. The same for deposits that haven't cleared. They're known as DITs, or deposits in transit. Good thing to add to your vocabulary list. A DIT is a deposit in transit. It's a deposit that has not cleared. So we're going to see that it's important to understand these two perspectives when we do a bank reconciliation. So this is the best to memorize, and this is what I call the bank reconciliation formula. This is not in your textbook. That is, take the balance according to the bank account and add deposits in transit, subtract out outstanding checks, and you'll find the correct balance for the accounting records, or the actual balance. This one is consistent. This is an easy formula to memorize. So reconciling a bank account is a matter of taking the balance off of the bank statement plus deposits in transit. Those are the deposits that the bank statement hasn't yet recorded, minus outstanding checks. Those are checks that haven't cleared yet. We're going to do a couple of examples. This one is from the book. If the bank statement shows this amount and the ledger or the checkbook or the accounting records show this amount, and this information is identified, there's a deposit that hasn't been recorded yet. A lot of students go, what do you mean a deposit that hasn't been recorded yet? That means that maybe on a Saturday morning, the business took $816.20 and made a deposit. Some banks are open on Saturday, but you can also make deposits through an ATM machine. And of course, you can make deposits through your cell phone these days. Makes me a little nervous, but you can make deposits that way. The bank would not possibly have that recorded on their bank statement. Also, the bank wouldn't have these checks. If the person these checks are written to has not cashed them yet, then they're considered to be outstanding. So these pieces of information are enough to give us the correct balance. But we do a double check by saying, okay, what do my accounting records show? And let's look at these two pieces. And these two pieces are that we have a notes receivable plus interest, and we have what I call a bounced check, and we have a service charge that's not been recorded yet. And so let's look at what the bank reconciliation is going to show. Cash balance, $33.59, plus any deposits in transit, which are here. Notice this is a plus, minus these outstanding checks. There are 3 and they total to this. And we come up with the actual adjusted balance of $2,630.99. And that is the correct balance. Now we have to get our checkbook or our T account or our general ledger account to show this. If a general ledger account shows $25.49, there are 4 adjustments that were provided. One of them is to add this note collected by the bank plus interest. This one was the bounced check. Here's the service charge. And I failed to mention, but there was an error in a check. And that frequently happens where the transaction is keyed into the accounting records incorrectly. So this is an error in a check. So what we have now is an adjusted balance that matches. These two match, and this is what the accounting record should reflect. And if you were to wait a couple of days, then no doubt this deposit would clear and these checks would clear the bank and the reconciliation would work. Now I want to pause and provide just a quick minute's worth of personal financial planning, and that is most individuals don't reconcile their bank account. And by failing to do so, there's the possibility that there are errors recorded. There's the possibility that there's an incorrect running balance in the checkbook. For those individuals that do keep a checkbook, for those that keep only look online to see if they have money in their bank account, that's not a correct or accurate measure of how much money is in the bank account, because there could be checks that haven't cleared yet. And once you get to a situation where there's more than one person involved in using the cash within a bank account, it can become quite complicated. So my strongest professional advice is that each individual, when the bank statement comes out, maybe it's electronic, you can print it out, and you can actually do a bank reconciliation. I also suggest that individuals keep a checkbook. You're going to find times where you can't use a debit or a credit card. I'm sure most people have found that, where you actually do need a check. And in doing so, you're going to need to record those transactions in a checkbook. Finally, for tax purposes, oftentimes if you make a charitable donation or pay a medical bill or property taxes, even if you do it by EFT, it should be recorded in your checkbook so you have a clear record of a tax deduction that you don't miss, and you can keep up with those transactions accordingly and save on your tax return. And again, that's another class, that's a tax class. Once the bank reconciliation is completed, a journal entry has to be made. The transaction has to be recorded to show those items that occurred on the bank statement that affect the company's records. So in this example, we have to record the notes receivable and the interest receivable from the loan that was collected by the bank. And we also have to show these three items that were subtracted from the balance per bank. So our cash goes down here, and in this example, our cash goes up. And after these journal entries are recorded, the cash account is going to agree with the bank reconciliation, and everything is the way it's supposed to look. So these adjusting journal entries have to be recorded to make sure the bank reconciliation is in sync and the adjusted bank balance is correct. Just like you as an individual might show in your checkbook that you had to pay a $10 service charge and you. Okay, so let's try a bank reconciliation ourselves. This is one that will allow you to practice. It's not one found in the text. We've got the bank balance that's coming from the bank statement, found online. Usually easier for me to print mine out. And we've got the book balance. So for an individual, it might be literally a checkbook. For a company, it might be the number they find on their general ledger or T account. We see a service charge. Students should be thinking, okay, a service charge is something that's going to be subtracted. We see a bounced check of $200, a deposit in transit, 3 outstanding checks, and an error. And in this error, you need to use logic to figure out which way does this error goes. Which way does this error go? So this is a check posted to the general ledger. And so it was subtracted out from the bank statement as $14.29, but it cleared as $15.68. So you have to decide, is the company pleased with that error? Is it in their favor? Do they add it or do they subtract it? So what I would like you to do is to try to use the template that you see in the textbook. Pause the video here and try the bank reconciliation. If you're stuck, my suggestion is that you take that memorized formula. Bank statement plus deposits in transit. So here's the bank statement. Add these deposits in transit and subtract the sum of these outstanding checks. And that will give you the accurate adjusted balance. Next, get your accounting records or your books to balance. The book balance is $1,800, and figure out what to do with the NSF checks and with the error that we have here. As well as the service charge. I hope you've taken the time to prepare this bank reconciliation rather than waiting to see it. So let me throw a little bit of educational research out there at you, and that is that hearing someone talk or reading how to do a problem is going to result in about 10% retention, but actually working on the problem is going to enhance that to 50 or possibly 75%. Teaching someone else how to do a bank reconciliation enhances retention to 90%. So at a minimum, I hope that you solved this answer yourself before you're looking at this slide. And the answer is $1,436. So let's go through and see how that works, because the adjusted balance per books and per bank is here. The balance per bank plus DITs minus the 3 outstanding checks that we've summed up to be $64. The accounting records or the book balance is $1,800. We subtract out these 3 things. The clearing error was a subtraction, and we find again that the adjusted balance is accurate. This is something that should be done by all individuals, especially by all businesses. And businesses that don't do a bank reconciliation are usually found to be negligent in their internal controls, because it's one of the most important controls that an individual can have. Finally, the book balance here of $1,800, what we have to do is go into the accounting records and record these 3 subtractions from cash. So subtract these 3 amounts, and on top of that, we're going to record a service charge expense. We're going to take this NSF check off and show that it's an account receivable from the customer. And we're going to show this clearing error wherever that check was recorded. So let's move forward to a new concept called the petty cash fund. And these are kind of fun. Some of you may have dealt with them before. It's just not practical for a company to constantly be writing checks or to give a credit card or a debit card to their employees, but maybe the employee has a truck and they need to put gas in the truck, or maybe they need to stop and buy lunch or pick up something for the office. So there's usually a special fund called the petty cash fund. And this petty cash fund usually is started by a debit to this account called petty cash, and it is an asset, and a credit to cash, and it shows that there's $500. In this, usually it's a drawer. Sometimes it's a little locked safe deposit box or something. Frequently, an administrative assistant hangs on to the petty cash fund. Okay, so at the end of the accounting period, whenever the person controlling the petty cash fund goes in, they find that they're missing quite a bit of money. There's only, okay, me and my math, $33 left. And they go in and look at the receipts and notice that there are receipts. And these receipts have to be put in the box every time cash goes out. So what typically will happen will be you might have one of your drivers come in and say, I have to stop and pick up something and I need some cash. And so the administrative assistant might give him $20 and she'll say, come back with a receipt and the change. And that's generally the way it works. So when all of this is said and done, at the end of the month, $467 has been spent for office supplies, store supplies, and miscellaneous. And a check is written and the cash is placed back into that safe deposit area. I mean that in the way of the office. So lots of times it's a little lockbox, and it restores the fund to its original $500. And all of these small amounts are recorded in the accounting records. I want to talk to you about financial statement reporting of cash. Frequently, big companies have a lot of excess cash, and they usually invest them in something that's very liquid. Liquid meaning they can easily get their cash back out, like a money market account that has checking account power. They can transfer $100,000 in it one day and pull $200,000 out of it the next day, but it at least is earning interest income of some sort or dividends. So I guess a big personal financial planning piece here is that idle cash is not a good thing to have sitting around. It should be used. And by saying it should be used, we mean that it should be used to earn dividends or interest income for the company. So if this company has temporary excess cash, they might invest it in an investment that's going to be there for less than 90 days, like a treasury note or commercial paper or money market fund. And these cash and cash equivalents, less than 90 days, I always see that asked on exam. And companies that have invested excess cash usually call it cash and cash equivalents on their balance sheet. It's just the title. Cash equivalents are things that are invested for 90 days or less. Finally, for this chapter, let's look at the consolidated balance sheet of Apple Computer. Consolidated just means that they've combined several subsidiaries, maybe small companies that Apple Computer owns, into one set of financial statements. So this consolidated balance sheet is as of December 24, 2016. That's their fiscal year end. That's the most recent balance sheet as of the date recording this PowerPoint, this narrated PowerPoint. And I've pulled out the total asset section of 321 for the current year, 290 for the prior year. So you can see they've grown. And if you skim through the different accounts, you can see how much they've grown and where. Notice it is a classified balance sheet. Current assets, and then other types of long-term assets in here. Some we've talked about, like plant, property, and equipment. Others that we haven't, such as intangibles, other non-current assets, and we'll talk about long-term marketable securities in a minute. So these assets show cash and cash equivalents, as we just learned. That's cash or investments that will be turned into cash within 90 days or less, such as a money market account. They also have short-term or current marketable securities. These are marketable securities that they're not investing for anything more than a year or less. Now, I want you to stop a minute, and this is not $46,000 here. This is not $20,000. It's in the millions, which means this is 20 billion and this is 46 billion. Their total current assets are $106 billion. And let's pull down to their long-term investments. And these are long-term marketable securities. Securities meaning investments in common stock of other companies, or maybe bonds, or possibly preferred stock of other companies. These are investments in other companies. $170 billion. Walmart is very well known for the amount of cash that it holds. So this is their actual cash and cash equivalents. They have enough that they can throw another $46 billion into the stock market, into marketable securities that they plan to cash out within the next year. And then long term, for over a year, $170 billion. Just to show you a little touch of the real world. Any publicly held company can be found online by looking for their annual report. I hope you'll take the time to stop and look at this. It does help because when you take your BADM 212 class, you're going to be preparing an annual report as a class project. And I think it's very beneficial to continue to look at these live annual reports, real life annual reports, as we go through and study things. So this concludes the chapter on cash and internal controls, discussing petty cash funds, how to set up a bank reconciliation and prepare one,